Hello, everyone, and welcome back to the first of our three headline panels of the night. We have here Barney, who's leading a panel on decentralizing the business of liquidity. With Barney, we have Freddie Farmer, Anjan, and Carlo. I'm sure they'll get to introduce themselves properly when I hand over to Barney. This will be we're going on until 7 p.m. British time, so 15 more minutes from now. Let's see how the conversation goes. I'll hand over to Barney without further ado.
Thanks,
All the
Dave.
best, guys.
Cheers, guys. Thanks, and welcome, everyone. I just want to introduce myself very briefly. I'm one of the founders of Vega Protocol, which is a decentralized derivatives protocol, and one of the things that we've been working on since the beginning is incentivizing liquidity, both for kind of creation of new markets and the creation of new liquid markets, but also ongoing incentivization. And obviously, that's also become a massive topic this year in the kind of DeFi space as well. So we thought it'd be great to bring some people together kind of to discuss liquidity and crypto in general, how that's working in DeFi, how the difference between order books and AMMs and all of the kind of issues around liquidity. We've got a great panel here, and I'm just going to hand over to the guys to introduce themselves, just maybe talk a little bit about what they're working on and their background and how it pertains to this, and then we can get started with the panel. So, Carlo, how about you go first?
Sure. So I'm Carlo, co-founder, COO of Hummingbot. So we've created an open source market-making trading bot that trades on both centralized and decentralized exchanges. We also wrote the original white paper on liquidity mining back last year before it kind of blew up in the DeFi space. And basically, if you're probably familiar with liquidity mining in DeFi, we basically launched a platform in March this year that does that on centralized exchanges.
Awesome, thank you, Carlo. Freddie, how about you?
So I'll just come off mute. So I was the first employee at Wintermute Trading, which is an algorithmic liquidity provider. So we would be a centralized liquidity provider who would basically do, I guess, what is equivalent to what Hummingbot does, but it's not open source. This would all be proprietary technology. So I was there heading up decentralized finance initiatives and have left now, and I'm both investing in DeFi builders, massively interested in the AMM space in general, and kind of participate in all mannerisms of liquidity mining, which is definitely Hummingbot's original term, so you guys get that one. But yes, all of the farming and all those kind of things is what I'm kind of interested in right now.
Brilliant, thanks. And Anjan.
Hey everyone, this is Anjan here. I'm part of the investment team at Parify Capital. So Parify is an investment firm focused exclusively on the decentralized finance space. We invested in core infrastructure and applications across the DeFi space. We also serve as large liquidity providers and users of many DeFi protocols. So, we like to leverage our insights as power users to also inform our investing thesis. Super excited about all the liquidity mining stuff going on, and we're seeing some of the most talented teams in crypto work on DeFi, including Vega. So excited to be here and looking forward to the conversation.
Brilliant, thanks guys. Just a quick note, we were hoping to have Carlson from Fractal join us. He's currently experiencing some connectivity issues, so not sure if he is going to be able to join or not, but if he does, we'll kind of slot him into the panel as we go through. So really, I wanted to kind of introduce this by talking a little bit about liquidity. I spent the beginning of my career working in kind of, I guess, traditional finance with kind of trading firms and exchanges like the London Stock Exchange and a number of large investment banks as clients of mine. And you'd always hear the term liquidity thrown around, and it was never anything that was measurable. Certainly people wouldn't talk about, liquidity in such kind of absolute ways as they do now, and it was kind of always this thing that's provided by market makers, and it was always subject to different deals going on. The one thing you always knew about liquidity was that when you wanted it, it wasn't there. So when things go wrong, the market's going south, you suddenly found there was much less liquidity as there was when you were just happy holding onto your position. And so even quantifying how much liquidity is available depends on a number of factors, and I think that's the kind of thing we'd like to explore during this platform panel. To start off with, I would like to sort of open that question out to the panelists, though, because we have a number of different ways we look at liquidity, from the Hummingbot way of sort of order book liquidity mining to the AMM and CFMM type of sort of liquidity as capital provision almost, to kind of liquidity more as a kind of intangible concept that sort of traders think about when they trade on markets. So just wanted to open it up and maybe Carlo, as you're the sort of Hummingbot, you guys defined defined liquidity and liquidity mining. Maybe let's just sort of talk about how we each think about liquidity and what it means for a market to be liquid.
Sure. So I have actually a similar background before Hummingbot. I was in investment banking doing structured derivatives. So in that space, you have a lot of esoteric risks that you're trying to move around the market. So you have to find kind of a buyer and seller. So when we think of liquidity from our perspective here, it's in similar ways, how easy is it to trade an asset? And obviously with the crypto market space being so fragmented and so forth, one of the key metrics that we look at is slippage. So this is kind of a measure that even CoinMarketCap introduced to some degree in their ranking of exchanges last year. So we think of it as how easy is it to trade in and out of an asset. So that means a few things. One is to some degree, it's what venues it trades on. So is it available on an exchange that's easily accessible? That's kind of the first layer. But then within each exchange is, if I need to trade, there's kind of a few factors. So one is order book consistency, like how deep is order book, and will it dissipate when the market's volatile or not? So that's one thing. The other thing is kind of like, if I had larger amounts of bucks, what's the price differential I'm going to get? So basically, what are the screens showing, kind of mid prices versus what am I going to get executed at? So if you have very illiquid order books, obviously that's going to be a pretty big range, could be several percentage points. But other markets which are highly liquid, you expect to see, even for large amounts and at any time, that the actual trade ultimate price you get executed at is fairly close to the mid range.
That's great, thank you. And so, Anjan and Freddie, do you have anything else you want to sort of add to that? Any other ways that you think about liquidity? Do you agree with that?
Yeah, no, I definitely agree with Carlo's approach, and I think an interesting perspective that Hummingbot brings is they're in a way kind of democratizing the actual ability to provide liquidity, right? By being able to run these bots and being able to provide more market making, that's ultimately helping improve the liquidity of these exchanges in a very economically incentivized way. I think the other component to think about here is, well, what actual venues are you trading on? Is this a centralized exchange? Is it a decentralized exchange? I think when your definition of liquidity kind of varies, right? In some of these AMMs, for example, say Uniswap or Balancer, which quote unquote may have a ton of liquidity in terms of the total value locked, but what does that actually mean in terms of the trading experience? Well, on the curves themselves, even though you may have massive amounts of liquidity, the way these AMMs are structured, the curve structure themselves, they may not facilitate great execution themselves. So the liquidity in terms of total value locked, or the DeFi mindset or characteristic may be there, but in terms of the actual execution, the trader may face a ton of slippage, just given the inherent kind of dynamics of the AMM curve itself. And that's less of a fact, you can argue that's less of a factor of market liquidity, and maybe that's more of a factor of the actual AMM curve itself. And that's something we can dive into kind of later in the panel, but essentially some of the differences between stablecoin trading on curve versus stablecoin trading on Uniswap, for example. They both may have the same amount of maybe core liquidity deposited, but the slippage or the execution you get is fundamentally different.
Yeah, and I think, look, there's not too much to add to that. I think it depends what the kind of mindset you are. I think talking of those TVL metrics in DeFi, that kind of is an attempt to show the total liquidity available. But as we know, really with the trader's mindset on, I'd say it's both the ability and confidence that you can have in entering and exiting a position that you put on. So that's kind of how I just one line and probably explain how I see what a liquid market is. And that's suitable for different sizes of traders, when considering different risks that they have to either put on or get out of.
Brilliant, yeah. And I think, Anjan, you touched on a really important point there, which is kind of the AMM curve thing. And one of the ways I think about it is that what AMMs do is they don't necessarily acquire liquidity super efficiently, because as you said, like $100 million locked up in an AMM curve is probably way less useful than $100 million worth of orders close to the bid and the offer on an order book. So, in terms of how liquid the market is, there's a huge difference into the AMM curve, $100 million versus $100 million worth of orders if they're well placed. But what the AMMs do, I guess, is they make it easier for someone to supply. So they basically increase the amount of capital that can participate, because if you're going to place orders on a book, you're going to have to deal with inventory risk, you're going to have to price them, you're going to have to actually manage your position, and in AMM you're not. So I guess, That's a core concept which I think is really interesting in the sort of the DeFi versus CeFi. That like, how do you provide liquidity in crypto? What are the pros and cons? We've talked about some of the cons of the AMM liquidity, the curve going in there. But does this matter in practice? Is it actually the case does that mean that you're going to have difficulty reaching the levels of liquidity that you see in centralized markets via AMMs and via sort of CFMM type curves, or is that actually not a big problem?
Yeah, I mean, maybe I can just kick it off here. I think it's a great question. I think what we're starting to see is, we have this generalized AMM model, such as Uniswap or maybe even Balancer. And what you're starting to see is that it's not a one size fit all for all types of assets, right? And I think this is where the design space is really interesting for liquidity mining and trading in DeFi specifically. So let's look at Curve, for example. They're also using AMM model, but the curve itself is fundamentally different from Uniswap or Balancer. And what we're seeing is stablecoin trading is actually more efficient and cheaper on Curve than many centralized stablecoin markets and quotes you can get to the OTC desk. So that to me is an automatic improvement of DeFi and fundamentally shows the advantages of an AMM, a specific type of AMM, used for a very specific use case. And I think, we're going to start to see more and more specialized AMMs come to market, whether it's for prediction markets, whether it's for options, interest rate swaps, whatever it may be. And so this allows liquidity providers to earn a passive yield, but for traders to actually get good execution on very specific assets versus the one size fits all, such as Uniswap or Balancer.
Makes a lot of sense. So, a question I guess I would sort of bring up as well. Obviously, partly, providing liquidity is providing liquidity, but actually, even in this sort of the AMM style of liquidity, when you place liquidity in those, depending on the sort of ratio of how you place the assets, for instance, you're placing a view on the price of that asset, and you're helping to price it. So. One thing I'm kind of interested in, what's the relationship between like the revenue that a market maker makes, the incentives that they get for providing the liquidity, and the overall sort of underlying liquidity of the platform?
Yeah, I guess I could get started there. I think everyone generally is pretty much profit driven. So they're in this to make sure overall they generate some value from it. So I think market making is kind of it's generally very hard to make profit unless you're taking directional views. That's why you have traders on Wall Street who are market makers. They're good at it because they can make directional views. But in a lot of cases in the crypto space, because it's so volatile, it's hard to make money. So market makers require other ways to make money. So whether before AMMs, whether it's like that they'll provide market making for their tokens and these things. So that's a big part of it. And what's interesting now is we've kind of seeing it evolving. So market making incentives aren't really that new. They're just kind of evolving. So I think one of the biggest kind of clear examples happening right now is like Sushi Swap. And I think like where you had before Uniswap, there is these automated market makers, you still have risk. You have the concept of impermanent loss. And Uniswap kind of got some traction, but the rewards there probably didn't make up for that strategy for profit. And so what we've seen is things like Sushi Swap, where it's basically the very same contract, but you're adding a sweetener of incentives. Then it comes a point, and then we've seen kind of participation massively spike. And I think the interesting thing there is that the Uniswap incentive model is probably not sufficient. And so why these things like Balancer or Curve have really proliferated just in the past few months is because they've added more on top of that. And so now kind of quantify impermanent loss. And this is actually something we struggle with as well. It's how do you quantify a market maker's loss? For us, where we're introducing lots of new traders to market making, it's hard to evaluate how well they're doing. But then right now, with Balancer, Liquid, and all these other AMMs, incentive liquidity mining incentives, you're kind of masking that. So overweigh the permanent loss so that it becomes a less significant part of your profit calculation. So it's kind of less less significant. So that's why a lot of folks are increasingly participating in these, because it's a lot easier to do so. So I think right now we're probably still kind of figuring out probably too little, but then the balancer and other liquidity mining protocols are probably too much. And so I think we'll see it's kind of will evolve, and that's something we are working on ourselves to try to see what's the right level of incentives for market makers.
Right, it makes sense. And I guess talking to bring together a couple of concepts we've been talking about there. We were talking a little bit earlier about the difference between, say, $1 of liquidity in an AMM pool and $1 that's kind of close to the best bid and offer on an order book. Obviously there's a kind of efficiency thing going on there, in terms of the efficiency of capital deployed versus liquidity that gives a market. And so, something that I've been thinking about a lot is the idea that, if you can deploy $100 more effectively to effectively provide more liquidity than someone who's deploying that into an AMM, then effectively the rewards for that $100 are going to be much higher than if you're getting less liquidity for it, because effectively what I believe is that liquidity begets trading. The more liquidity there is, the more of the demand for trading is going to be satisfied, because the less slippage there is going to be when people want to access the market. And so overall, if you can provide liquidity more efficiently, you should end up effectively receiving more rewards for the same amount of money than if you were providing it very inefficiently. Is this something that's going to make it hard for? I think there's AMMs obviously have a role in very illiquid markets where the cost of liquidity provision, the fixed costs of running the algorithms and participating are too high. So AMMs have a clear role there, because I think it's basically you don't pay those costs. There's no humans needed. But once you try and scale a market, is that efficiency problem going to mean that AMMs can't compete with centralized, or not necessarily centralized, but with order book based platforms where people can provide pricing information and more efficient liquidity? Or is there a way they can keep up?
I think I think the design, as Anjan spoke to, I think the design space of AMMs is just going to continue to increase. I think it's needless to say that at the moment they're limited in capacity. I mean, the majority of them sit on the Ethereum blockchain, so they're actually just limited by throughput as a design. And I think what they're very good at is supporting the long tail of assets, which is what Uniswap, as the original kind of proposed itself to do. I think what's kind of important is if you take a bit of a step back and you just kind of view what a centralized market maker is very good at, and whether you can abstract those things or abstract them away enough and incentivize people to apply those to AMMs, I think that's going to be a really, really exciting space to both invest in and partake in. But I think if you just look at what traditional centralized market makers, the Wintermutes of the world, do really, really well, is they're very, very efficient. So they have the ability and the confidence, in the prices in which they quote. And they also have the ability to vary those to ensure that they don't get run over. So they never take the opinion that someone on the other side of their trade has more information than them. They just make sure that in the long run they adjust, so they only pick up natural order flow. I think what's kind of interesting when you look at centralized market making, I think Carlo spoke to itself. It's actually quite hard to make money. You need pretty much economies of scale. And centralized market makers have power law distributed, so the majority of the income from a market goes to the very, very efficient market makers who have economies of scale, very low cost of capital, and who turn over their inventory. So they trade their base of inventory many, many times a day. But I kind of feel, I guess, having had that mindset, but being so interested in decentralized finance, is what's potentially clear is that what market makers aren't as good at, and never will be in terms of the long tail, is the rapid coordination of inventory. So they will always want to remain delta neutral. They'll look for a service which allows them to borrow that inventory so that they can remain flat in the market and quote. That's not something you necessarily do as an LP in a decentralized AMM like Uniswap. You are taking price risk and impermanent loss risk, if you can want to call it that. And I kind of think that, sorry, Siri's joining the call. Spooky. It always comes up at the weirdest times. But look, I think what is interesting is I think they have the potential to be a bit of a 0 to 1. Like you may have seen, if you were to provide inventory to a market maker or lend to a market maker, you can get very comfortable with the risks they take. so they can borrow very, very cheaply. But it is potentially possible for the power advisors of the world who sit on various investments and inventory to allocate and use that capital for something very similar and not quite as competitive, but very close on many markets going forward. And I think that's where it will get quite exciting.
I agree. I think that's a very, very interesting point. And that leads me to something actually that we've been thinking about a lot at Vega, which is the idea of the kind of the incentive solution space that you create by removing the exchange. And what I mean is, when I work with exchanges and large banks, it's very clear that they're taking a huge amount of money out of the system compared to the value they bring. They are not actually the market maker. They might pay a market maker early on in a market's life. They might give a small rebate, but the market maker is still actually paying fees. And so if you remove the exchange and you put things onto a decentralized footing, when what you're seeing now with the rewards that liquidity providers get on Uniswap and indeed on platforms like Vega as well, is that you can basically share that revenue that would otherwise have gone to the exchange and still have reasonably low fees. And I think what's interesting with that is that you can kind of incentivize people to keep the liquidity there when they might want to take it away. And you can kind of incentivize them so that fact, like you said, making money as a market maker might be quite hard. But if you receive 2/3 of the revenue that an exchange would have made out of the trading during that same period of time, now actually it might be a profitable activity to supply liquidity to that market, whether it's in an AMM or something else. And I feel like that's a really interesting way that we can potentially create more liquidity in the decentralized space than in centralized markets. And is that something that you guys see?
Yeah, I mean, absolutely. At Verify, we work with a lot of DeFi teams very closely, and we're always thinking about, how do you incentivize the right type of activity, whether it's TVL, trading volume, whatever the activity is, using a thoughtful token design. And I think what we've seen over the past couple of months is liquidity mining has kind of catalyzed the DeFi space by encouraging a ton of passive capital to come and deploy onto these various protocols. I think the next iteration of that is, look, capital's flowing. It's very fluid, right? Every new sushi or kimchi we see, capital immediately moves to other protocol. But I think the real question now is, how do you create lock-in effects with this capital, right? How do you have a thoughtful token design that creates a lock-in effect so that capital doesn't immediately flow from one protocol to another? Very similar to how, I guess, in the centralized exchange, you have designated market makers. You don't want those market makers leaving every day or every week. You want to have some type of consistency and commitment to the markets that you're providing liquidity and using. And I think creating lock-in effects with these new token designs is going to be incredibly important to making sure that these protocols continue to have liquidity, well beyond these rewards kind of dying out and no longer playing a role.
Absolutely, yeah, and that's something in the Vega design for liquidity reward. What we effectively do is we treat liquidity providers almost like investors, like equity investors. That means that if you join a market, we value the market based on its trading volume, and if you join a market while it's small and commit liquidity, effectively your share of the rewards is higher than if you join when it's large. And the goal of that is exactly what you said, to actually give people a reason why they got in, they supported the market early, they're now profiting, so it's now worth continuing to support it. It gives you a reason to support markets that need it, and it gives you a reason not to just run away at the first sight of things. So we're thinking about some of that stuff, and I think that's very, very interesting. And something else that we've been thinking a lot about is kind of, one of the things I think is that market makers do when they provide liquidity, when they think about the risk, is they actually synthesize a lot of information, which is very hard for algorithms to synthesize, that means that market makers tend to help with price discovery, or at least, in liquid markets with order books, they help with price discovery. And, one of the things that I think, we talked a bit about stable coins, where maybe it works okay to have an AMM because you're actually not moving very much. But if you look at, some other types of situation, you can imagine, where you're valuing a company. If the company goes bankrupt, it doesn't slowly follow a curve down to being worth nothing. It is worth nothing. And I think, that's where someone like a market maker and priced orders has a huge advantage. And I think, particularly interesting Carlos's view, because obviously you guys have been thinking about liquidity mining from an order book side. How can we best integrate, how can we best make efficient markets that are liquid and that are well priced, that also provide these incentives and provide for liquidity mining and kind of, work in this sort of DeFi setting? How can we kind of marry those things together?
Yes, so what we've done is we've kind of created rules, and you're working on that as well. So how do we try to quantify it? So what we've been doing is So we're a data-driven company. So we've been actually using actual orders from folks to determine pricing. And it's kind of an iterative process because it's we have to collect a number of data points. I think we've been running campaigns for a number of issuers. So there's a lot of things that, like, for example, we weight tighter spreads versus wider spreads. But setting the right amount to do that, it's just a bit of, takes time to kind of establish that. So similar in AMM space, like what are the amount of rewards, Uniswap versus SushiSwap? There has to be for us, we have the advantage that we actually have data kind of play around with some of these tools, and like what max spreads are allowable, what the spread steepness curve is and see how that impacts the market maker's behavior. So I think it's kind of still at early stages, but we're running the right way to make. And it's kind of still, it all depends by market. We have to factor things like how volatile market is. There's lots of factors that go in. So I think just what we're trying to do is create a framework, at least to kind of quantify what those risks are, and so we can align that. So for us, we think that's at least a step in the right direction, and it will just take over time, based on data that we get from participants. That's something we'll be able to refine and evolve on.
It's sorry, Carlo. I had like a little thought, which is quite funny, but I can imagine I can imagine Hummingbot making for an incredible agent-based simulation for like a future AMM. Kind of using basically all of the users of Hummingbot figures to simulate a complex phenomenon, which is to the effective and efficient provision.
Yeah, that sounds very interesting. So, do you guys think that with the tools that we're building and have built kind of in crypto and in decentralized markets, do you think that it's possible to build markets that are as liquid as the equity markets or the FX markets in traditional finance? Do you think that's something we can achieve with a fully decentralized marketplace?
I think there's potential. To be honest, I think one thing right now is that's hard to see through is right now there's just not that many assets available on the Ethereum exchange. Cross-chain problem. The more there is, then it becomes a lot easier. So with a lot of financial markets, there's a lot of blockers. You have to set up accounts, get licensed, all these things. But if you have more accessible to many more people, more participants, then I think that there is potential just to have that once we refine and get over these initial kind of technological things for that. But I think there also be places, even in traditional markets, where I think in 80s, 90s, there was always the concept of electronic trading, sales and trading desks obsolete and things like that. There's always going to be kind of different needs that need to serve different cases. But I think in crypto space, for general usage, for ordinary folks who are not professional traders and so forth, I think the possibility of having so many people involved and having the barriers to entry be accessible to anyone does create the potential that it could be adopted more generally by a large amount of the public.
Yeah, I would agree with that. I think it's kind of clear the potential is there, but I think we also need to take a step back and think about where we are in terms of the layer 1 and layer 2 scalability, right? Because that is a clear bottleneck right now, right? Like, Ethereum cannot support, it's already running into throughput issues right now. Now imagine when you scale the number of assets, the number of users. I mean, this bottleneck is it's a serious problem for Ethereum right now. So I think as we see improvements at the base layer, we're seeing a ton of experimentation and implementation on layer 2. That's really promising from bringing on the high volume traders, because right now it's very difficult for active traders and the really serious high volume traders to partake in AMMs or DEXs or any type of decentralized protocol, just given gas fees, front running issues, just general throughput issues. Once we have those scalability improvements in place, better UX UI improvements, then I think we could see more traditional market makers jump in and participate in more complex trading and market making strategies that aren't inherently limited today by the kind of challenges of scalability and throughput at the base layer right now.
I would say from the point of view of a more centralized market maker though, and this is the classic, the chicken and egg problem, liquidity, is touted a lot. Ultimately, a market maker will go if, for example, order flow just begins to aggregate around AMMs, then market makers will go there. There's absolutely no reason for not. I agree that the bottlenecks right now, because it kind of shows that these decentralized fabrics are providing a lot of value to a lot of people, or building out new business models, or even completely new paradigms of how one trades with each other. But to go back to Barney's original question, yeah, easily I think will be the answer in terms of competing with. If you just go down to first principles and you view like an Ethereum wallet as just the financial. If you view, sorry, not necessarily Ethereum, but if you view your your wallet or your account as just like a financial passport in a way, and a kind of a single sign-on to all services in the same way Google might be able to offer you a lot of products. I think you can just compare your ability to, your ability and your rights in terms of ownership of what you're doing with your finances. I think you just have to compare that with maybe, the percentage of funds held at banks versus in cash or other assets that people have under their beds. And that's really all if you're really talking that kind of scale, but will it compete? I think you really need to just look at that as the single first principle frictions to look at.
Makes sense. And then I guess sort of a follow-on question here is a couple of people have mentioned things like the gas fees on Ethereum, the front-running issues, and obviously you're going to get Ethereum 2, so the gas is going to get, things are going to get somewhat alleviated, but even the level of alleviation, the level of throughput increase that you're going to get on Ethereum 2 is nowhere near the level that you would expect to get anything like the amount of trading that goes on in the current off-chain world. So it feels, I guess one of the question I'm coming to here is it going to be possible to, is it going to be necessary rather to move trading off of Ethereum? Like to succeed outside of crypto, is it going to be necessary to move decentralized trading off Ethereum, either to kind of, app chains that are developed specifically for trading, or at least to higher throughput blockchains? Is that going to be something that's necessary, or is Ethereum going to stay the place because of the kind of the network effects of the DeFi protocols and all of those things?
Yeah, I think, and there's a lot of folks working on solutions now. I think everyone will go where the venues works. I don't think anyone's necessarily tied to Ethereum. I think we're paying out for just to pay us like a few dollars worth of USDC, for example. It just doesn't make sense. I don't think, at least for us, or I think goes to what I said earlier, is everyone's profit driven. So everyone will go where things work. I don't think I won't necessarily trade on Ethereum just because I like Ethereum and I'm loyal to Ethereum. If there's a venue that's better, I think I'll go there. Lots of people will go there as well. So I think it's just and a lot of these protocols are in the works, and I think we will see. It's a big opportunity for those protocols right now, because in the last few weeks have really the problems with Ethereum. And so I think we'll see people continue to develop other layer ones to accommodate similar functionality of Ethereum. And once those become better or proven, I don't see why people wouldn't move there pretty much immediately.
Yeah, so I guess you're sort of saying, really, there's things traders look for, and that's they want all those things we defined when we talked about liquidity. They want certainty, they can execute, they want low slippage, they want all of those features, capital efficiency, and all of that. And so when people come along and create decentralized platforms that are faster and cheaper and better, you think not much is going to cause them to stick around on the Ethereum stuff if it stays much more expensive and worse.
I think we've even seen that historically in the centralized exchange space. You had like Mt. Gox, Poloniex, Coinbase, Binance, and it's even though some of those have been established for a while and are the predominant player, every few years someone comes with something better, and everyone goes to that new platform. So I think it probably will see the same thing here as well. But once there's clearly a better product, I think we'll see a lot of folks adopt that.
Makes sense. It's something I see as well. I think I'm looking at the Ethereum space. I think in order to kind of challenge finance, I guess, then I think there's going to be a need to move outside of that solution space to solve some of those problems. We got, just looking at the chat here, we've got a question from Morgan and Hemia, which is there something which, if DeFi had it, that all market makers would have to come into DeFi in order to compete?
I'll let one of you guys take it, because I kind of answered cheekily saying, what makes you think they're not already here?
Yeah, I mean, I guess as I think about it, it's less of binary. It's not as binary, right? It's not like there's no market makers and suddenly there's all market makers, right? It's really a spectrum. So you already have some pretty forward-thinking market makers kind of in the DeFi space, actively providing liquidity across AMMs, whatever the order book models are, Curve. And then you have initiatives like the Chicago DeFi Alliance also kind of bringing in some of these more institutional players. And so I think it's less of like, hey, we need one specific feature and all market makers are going to jump on board. I think it's a spectrum and it's a journey. It's ultimately a learning process, right? Are the market makers comfortable with, interacting with these protocols? How easy is it to interact with these protocols? Is the documentation clear? Is there API access? What assets are available? So I think it'll be a market maker by market maker decision. And I think they'll start small with one or two protocols and they'll eventually continue to provide liquidity. But I would say it's less of, one specific feature that's going to catalyze and bring all market makers on board. I do think there are a couple different pieces that may help market makers come on board. So one, maybe scalability or throughput, right? So something like a Diversify, for example, with layer 2 and Starkware integration can facilitate somewhat more traditional order book trading than say something like Uniswap. So that's kind of an advantage for a market maker. Or if you have good documentation or API access that allows market makers to develop very more complicated strategies in the traditional AMM model, that kind of brings market makers in. So I think net it's just a series of steps and a journey to get market makers on board, less of a let's all jump in at once.
I'd agree, and I think my first thought when I saw that comment was trading, right? And if trading is happening and if there's demand for more trading to happen, then market makers will make money. If there's no demand for more trading, then it doesn't matter how much liquidity they throw in, they're just going to be throwing good money after bad and making no return. So it is the chicken and egg problem. You need enough liquidity for people to trade, and then people will want to trade more and it'll grow and all of that. And I think for me, it's kind of one way I think of answering the question is, how do you bring the flow? How do you bring the users who create the revenue for the market maker? Because when those sort of, your first token allocation to the community dries up, or your VC funded incentives or whatever they are, when you run out of those to give people, if there's no one left trading, then the market makers have no way to make any money. And so, ultimately, we've got to create that engine so that when you take those things away, the incentives and the design of the token, the design of the platforms, the design of the mechanics is actually encouraging people to create markets, encouraging them to trade, and encouraging them to make the markets.
There is actually one secret. Thing that is already being made as well. I don't know if it's made or designed, but I think in terms of, at least in the AMM structure, because it's so simple to onboard an asset, you get the risk that there's no filtering. So I think Anjan mentioned Kimchi. It's basically a pure pyramid scheme. It's like because you can arbitrarily set the market cap off one individual trade. The market cap of wine is very large if someone pays $10,000 for one glass of wine, and you value the whole thing of it. You'd be buying up bottles of wine very quickly and staking them in the wine ETH pool. Look, I think one of the killer features actually is around price discovery. So some AMMs are starting to see the long tail of assets that have not yet been onboarded in a centralized fashion. They are the primary price discovery venue for these new assets. It is absolutely paramount that a market maker has efficient and effective pricing or hedging venues. As soon as a centralized party or for example a sophisticated trading blockchain comes along, they can't hedge that risk. So in terms of something that Vega will be able to do fantastically is encouraging markets that that crypto traders are desperate for, but they don't currently have access to. That's something that's like a real win-win.
Yeah. I'll just add to that as well. I think we work and speak with a lot of market makers as well. I think a lot of the ones working on traditional exchanges are starting to look at DeFi now. It's on the radar for a number of reasons. One is even from the supply side, the token issuers, new token issuers right now are looking to maybe start with AMMs as their initial listing versus the other way around, because why would they pay exchanges millions of dollars of listing fees or be required to pay millions in market maker fees where they can just launch their token first on an AMM and gain traction there at a much more economical cost to them. So then what that implies is the business for market makers to provide is to some degree going away or has decreased. And so the venue for even one of the fundamental functions of capital markets is where to list your, as we see that shift to AMMs, that could be a big thing that will drive market makers. They'll be forced to look at this space because the traditional venues where they're earning business is just decreasing.
Certainly, and I think something that I always noticed and I thought was a bit crazy at the start of the kind of the 2017 rush, if you like, was the amount of money that some less prestigious projects were having to pay and were paying to create liquidity to allow people to trade their tokens. And some of the stories you heard about what exchanges were asking for to list a token were completely crazy. And I think one of the huge advantages that the AMMs have brought is to go, well, you want to allow people to trade in and out of this, you can do that. You just fill up a pool here and off you go. I think that's a big thing. Going back to the sort of this sort of thought about people moving in, what's going to bring people in. The thought that I have is, let's imagine that we're successful at this and that the amount of traded volume and value locked in DeFi grows by like 1,000x or 10,000x. Like markets suddenly become, not maybe half of all the trading, but they suddenly at least appear on the radar of traditional finance, and they actually start to be a really significant asset class compared to other liquidity. And that means that all of the big HFTs, all the liquidity providers, all the trading firms in traditional finance come in. What would that do? Like, what would that do to the traders and the markets and the liquidity providers who are there in DeFi today, kind of living in this quite small world? What would happen if the rest of finance really woke up and took notice?
You'll definitely have less alpha. Sadly, the market will become rather efficient. Definitely rather efficient. I think you can, which is good, which is great. It allows those who are looking to take directional bets to. I think the first question we discussed was, what does it mean for a market to be liquid? So not only will these markets have great size, but you will likely, suffer very low slippage as as these markets are kind of made or arbitrage to be more efficient. I think what will be more interesting is like how they sit. Do they sit more on keeping the market really, really in line from like an arbitrage perspective, if price discovery is happening elsewhere, or do they sit inside the pools? Or, for example, could they be pool sponsors? Changing some parameters in the AMM design ongoing to help, defend against arbitrage. But yeah, it's definitely be more efficient. It'll definitely be more efficient.
Yeah, and I would add that what we may also see is kind of the passive strategies themselves will just start to underperform some of these more active strategies, right? So the passive crypto holder or stablecoin holder, right now it can deploy capital in AMM and potentially earn the same returns as another passive holder. When you have these active strategies come on board, they may be more active strategies built on top of these AMMs that may start to outperform the actual passive strategies themselves. So I think net it's still positive for the space, because even if you have all these firms come in, they can partake in more active strategies, but there's still room for the passive holder to deploy capital in these AMMs and earn a yield, which I think is still fundamentally different from traditional markets where retail is somewhat priced out or unable to partake in any type of market making strategy, really.
Yeah. Something certainly, and I think maybe this is something that Carlo and the guys at Hummingbot, I would imagine, have thought about, is the idea of what crypto can do and what decentralization can do for the allocation of capital to liquidity provision. So if I think about traditional markets, everything's done by deals. You've got contracts. You've got to provide 60% of the liquidity on this market. You can't move money around very easily, and also the amount of money you have is quite static, and it's all sort of tied up in funds and deals and contracts. And then you look at the some of the things being built in DeFi and AMMs, and you look at the rates of return and some of the things being built on top of those. it feels to me like we're right on the cusp of a real huge improvement in the efficiency of allocation of capital to liquidity provision, because it feels like you can really optimize. If you've got $100 million to deploy, you can really optimize how much of that goes into each market to provide liquidity. And rather than kind of keeping tons of it in places where it's not actually needed right now, it can move to other places. And that feels to me like it ought to be incredibly good for the kind of overall cost of liquidity and the overall liquidity of the marketplace if you can kind of automatically deploy it.
Yeah, I think we'll see a lot more market efficiencies from this, because again, just an underlying premise that everyone will go where it's easiest to make money and where it's most attractive. I think to some degree it's kind of like liquidity arbing, if you will. So you go to whatever venue. I think now because it's using blockchains, it's a lot easier to move assets around without traditional financial systems that have delays and things like that. I think now we can do everything pretty much instantly to some degree. Yeah, it will make it more efficient, and I think it will expose wherever there's markets that are inefficient, it will just be less popular, or will have less usage, and we'll try to go to the ones where things are efficient. And as we see other players come in, even if the traditional financial players do eventually get into the crypto space, I think we'll see a lot more efficiencies overall. I think there's a lot of experience they can bring to the crypto as well in the industry that could help the industry develop as well. There's a lot of valuable experience that can overall help. So I think it's a good thing. Even though short term for the existing players, the alpha might disappear, but I think overall for adoption and development of the space, that would actually be a really good thing.
Yeah, I agree. I think and I also think there's a big differentiator that can help crypto to beat traditional finance because of some of the efficiencies we can automate. And kind of on a similar vein, we've got a question from Morgan, which is, would you prefer to see similar DeFi markets competing with highly liquid BTC USD markets, or would you prefer to see much tighter but low liquidity on altcoin markets? What's better for the range of retail users who could enter the DeFi space? I mean, I'd go for both if I could.
Hi guys, last question because we need to wrap up for the next session. Thank you.
Yeah, I'm happy to kind of start kicking things off. So yeah, look, I mean, BTC USD is it's the flagship product of crypto. I think if crypto is going to grow, the entire market is effectively correlated to that product. We're all basically kind of long skewed. So yes, I would love to see DeFi markets compete, and I think that layer 2, different scalability things. We should not just layer 2, but I think we're starting to see a good amount of new products and new technologies coming into the space that will allow us to compete. I think, for example, before one of your questions was, why don't we see 10 BTC quoted each side within $5 or whatever. And honestly, that is less because it's not already possible to do that in DeFi, and actually more to do with the fact that there are no retail users who want to buy 10 BTC. You might say there are, because there are quite a lot of significant retail whales in crypto. But I think more when we speak to retail in terms of onboarding new users to the space, I think you only have to look at things like Coinbase with respect to not Coinbase Pro, but its Coinbase app generates like $600 million worth of profit per year or something. So clearly the retail users are happy with the simple design. They're happy to pay quite significant spreads for a smaller entry. So I think that slightly less liquidity, but in altcoin markets, as in more interesting products that they actually would like to trade. Yeah, I think that's probably what we should be focusing on rather than just trying to.
Makes sense. We need to kind of wrap up very, very soon. I'm just going to ask one final question as we go, and the question is going to be, what one thing would you love to see happen that would drive greater adoption, greater liquidity in crypto and in DeFi markets? And for me, the answer is, I would love to see DeFi give people exposure with things like stablecoins to synthetic exposure on everything. Like, I would love to be able to get leveraged exposure to the S&P 500, to Japanese stocks, to the price of oil. Really like a one-stop shop with complete global access, complete global liquidity and leverage for basically any asset. I think doing that and allowing people to arbitrage and provide liquidity on not just crypto assets, but everything would be a real game changer, would bring a ton of liquidity and a ton of interest into the space. What would you guys love to see?
I think for me, I think one of the problems with DeFi DEX is things like UX. I think that's still, I would like to see it be a lot more seamless. And I think that's one of the things that prevents more users from adopting it. It's just hard to set up a wallet and figure out MetaMask, all these kind of things. So I think just having that UX, eventually better solutions for that will definitely increase adoption.
Yeah, I would agree with the UX. I think on the retail side, that's particularly important. So you have a lot of wallets like Dharma, Zero, Argent, which are helping with that, which I think is net really good for retail. But if you're talking about in terms of actual trading volume and liquidity, that's dominated by whales, of course. They're not as focused on how the retail app looks or what the UX there is. They're focused more on what strategies can they run, kind of the programmatic access to all of that. So I think a combination of those two kind of targets both retail and the whales.
Yeah, and I'm the same as you, Barney. I'm kind of synthetic exposures to everything under the sun. But I think one thing to add to that is I'd love to see that added into a slightly more sophisticated AMM. So I love Balancer, for example. Balancer is really cool because in essence, you could take all those synthetic exposures, create your index position, your passive investing, follow the market, you can't beat the market kind of stuff. But this time you're being paid to be arbitraged over the long run. So not only do you get passive exposure, but you're not being charged to mint or create those ETFs, you're being paid to have them from the beginning. And at least for us here on this call, if that happens, we'll have some very high returning passive synthetic strategies for the rest of our lives, probably.
Awesome. Well, thank you guys very much. On that, watch this space, because one of the things we are planning to do at Vega is to build a hybrid order book, which is effectively a combination of priced orders and AMMs, and I think it can be really exciting to be able to tap pricing signals and passive liquidity. We also really want to automate the ability for liquidity to move around between markets. So super excited to develop all of those things. Thank you guys for being awesome panelists and for providing your insights today. And apologies to Dagan and for running a little bit over. Thanks, guys.
Thank you. Thanks, everyone.
Thank you, guys. It was a really, really fruitful discussion. I 100% agree on the interface point for products in the space. So we will take a 5-minute break, and then we will move on to the next panel discussion, which is about derivatives in the proof of work and mining space and just in crypto native products. So I'll see you guys in 5 minutes time, and thank you once again for the panel.